No delivery forecast, but let's start off with something that Ross Gerber was telling us here on the program earlier in the session here, that he was really looking closely at those gross margin numbers, 17.6%, and when you adjust here for those regulatory credits, 17.2%.
Yeah, and it's important because automotive gross margin, X those credits, slightly above what were muted expectations. Tesla still has industry-leading margins for making electric vehicles. You know, if you strip out ZEV and you strip out the benefit of software, they still kind of lead in this space. But in the final 3 months of 2023, discounting price cuts, using that lever in both directions was a factor, along with, despite it being a record quarter in terms of sales, you know, an impact on the bottom line, which they've kind of stayed the course on.
I think it's interesting, too, when we talk about the gross margins holding up. Also, the free cash flow number came in well above estimates, more than $2 billion. I think the street was only looking for 1.5 years. Is that kind of a one-off here, or is there a trend line that we should be paying attention to?
Well, they're being efficient at a time where they're trying to ramp up production of Cybertruck, which is a new model. You have to spend to bring new product online because of the time it takes to staff up and tool up new assembly lines and the investments that are needed for that, at the same time as their profits taking a hit from the macro environment that we're in. But also, you know, this is the kind of first real financial read we've had since Zach Kirkhorn left as CFO. And Zach was a very good manager of the bottom line and very good manager of Tesla's cash position. His departure doesn't seem to have impacted that trend.
I want to go to something that Tesla said, which makes it really difficult to understand what's going on, which is that volume growth will slow notably. That's pretty vague, and we know that for 2023, they delivered a record 1.8 million vehicles, and a lot of analysts were anticipating something in the neighborhood of 2.2 million vehicles for this year. What does it mean when Tesla has talked so much about a 50% annual growth rate in deliveries?
What's critically important to state is that 50% CAGR, which goes back to early 2021, starting from the end of the 2020 financial year, related to production. So what they're saying on a compound average annual growth basis is that they would increase their production capacity and the number of vehicles they built by 50%. They built more than 1.8 million in 2023. Had they maintained that 50% CAGR, they would have been on track to build 2.5 million in 2024. But they're saying the opposite. A, they're not giving us formal guidance. They've omitted that from the volume, the graph in the deck titled volume. But what they're saying is that while they're ramping up their first-gen models, Y and 3, they also have imminent plans to bring on this next-gen model that we have few details about, which will be built in Texas. And for that reason, they're guiding us to substantially lower growth. But that growth, again, it is on a compound basis, and it's based on production, not delivery. But you can extrapolate out, right? And if they build less cars, they have fewer to deliver to customers.
And when we talk about this next-gen platform, we're talking about the lower-cost sedan. Is that right? Why not just go with that? Next-gen vehicle makes it sound like it's going to be ramped up to something akin to the Cybertruck.
Well, I don't know if you guys have your Tesla bingo cards printed on your anchor desks right now, but this will be a or the question for the call. You would have seen the Reuters report that Tesla has informed suppliers to brace for this. The understanding and the hypothesis for a long time has been that this will be a much lower price point vehicle, $25,000. The bill of materials, therefore, will be completely different. The lining up of the assembly lines in the factory in Texas, which is already trying to handle Cybertruck and Y, that needs to be thought through as well. So you think of it almost, in many cases, as downtime, preparing that facility for a product that is not yet there, but will impact the production of those that are already in production.
All right, for more, let's bring in Fast Money friend Gene Munster. He's a managing partner at Deepwater Asset Management. Gene, great to have you with us. What is your take on the quarter and your reaction to the stock move?
Melissa, this was the most sobering outlook that I have seen from Tesla when they talk about a step down, a notable step down in growth rates. I just want to put that in perspective. The street was looking for 19% revenue growth in 2024 for this year, and they said it'll be notably lower than that. So it probably comes in at 10%. When I see that, I think stock's down 5-10%. That was my initial reaction. I'm surprised to see where it is. The reason why I believe it's holding in is twofold. You highlighted the importance of the gross margin X credits. I would just add to that, that's the first time in a year that we've seen that improve. And so that is a surprise on the positive side, especially given the ramp of Cybertruck, some of that investment. And second, I think the stock reaction speaks to the conviction of shareholder investor base. And effectively, this comes down to a very simple question, is do you believe that EVs are the future? And if the answer is no, that you think that this is going to take 20 years to get to electrification and autonomy, then you believe the stock should be down measurably, meaningfully, 10% more on this news. But if you do believe in the future, then this punky, soft guidance that they're giving for this year is going to ultimately prove to be noise, because everything that Tesla's doing, building out this next generation vehicle platform, everything that they've done in their investments in autonomy, all of that is coming at a time where traditional auto is stepping back from these. And so that's the question. If you believe in electrification and autonomy, Tesla's actually in a better position longer term. And I think that the reaction to shares speaks to the conviction, long-term conviction that Tesla shareholders have.
Can you help us understand, Gene, what this next-gen vehicle platform is and what that gives Tesla in the long term? I mean, we may see that step down in volume growth this year, but on the other side of that, if we see increased efficiencies, if we see increased output, this could just, you could smooth this year over and see the trajectory higher.
You'd see an acceleration back potentially. I mentioned the 10% for this year, but next year could be 30% plus growth. And the specifically is that this is a lower price vehicle, likely around a Honda Accord. A typical Honda Accord in the U.S. starts at $30,000. That's below the average selling price of a car in the U.S. at $48,000. And it's likely going to be a couple vehicles. One is a lower price car with a steering wheel, and then followed by a robo-taxi. And so that's what they're talking about. They need to build enough of a gap between the Model 3 and this lower price vehicle not to create some confusion. So this is going to be, again, a measurably lower priced vehicle and compete with where the sweet spot of the growth in the automotive market is today.
Hey, Gene, it's Karen. Thanks for being on with us today. So I've always had trouble with how do you value Tesla then? Put it all together. How do you come out with a valuation for Tesla?
So what I look at is where the revenues are going to be in 3 to 5 years. I want to revisit it after the call here, but think about what that revenue growth is going to be. I mentioned a step back up to 30%. And then I go and look at what other companies are trading at. The best comp is Apple. When it comes to hardware, software, services, I think that's most representative of Tesla. And so that's a 6 or 7 times multiple. And so when I put those two together, I can comfortably get to above a $1 trillion market cap for kind of that 5-year period. Again, I want to see what's going on with their commentary on kind of long-term growth. But that's how I get there, as I think about this as a revenue multiple relative to where the revenue is going to be in 3 to 5 years.
Tesla shares in the red after missing on the top and bottom lines and saying their deliveries for 2024 will be at a slower rate than 2023. Joining us now, ARK Invest's Tasha Keeney and former Tesla board member Steve Wesley. Good afternoon to you both. It's good to have you guys here to break this down. Tasha, I'm going to start with you because it does feel like a mixed bag here. We had the misses on the top and bottom lines. We had the lack of details in that 2024 guidance, just the warning essentially that it's going to be slower in terms of deliveries. But the flip side of that is the auto gross margins, excluding credits, at 17.1% was better than expected and represented a sequential increase. Your thoughts?
Yeah, I do think, it's important to note gross margins, automotive gross margins, ex credits did tick up. And I'd say, broadly, the picture here is the future is really electric vehicles, right? We already know that. Other traditional auto manufacturers are actually cutting back on their electric vehicle plans and programs over the next 5 years. And they're not as profitable on those platforms as Tesla is, because Tesla's still the leader in EVs. I'll also say that for the future, we're very excited that Tesla is investing in AI, that they're focusing on the next generation vehicle platform, because we think that robo-taxis, that autonomous driving is completely going to change Tesla's business model. I think that could push overall gross margins up to north of 50% over the next 5 years. And I'm looking forward to hearing more about that on the call.
Okay. And I've heard you talk about that as well. We've heard him talk about that. Steve, I want to get your thoughts on some of the commentary we've seen in this release actually about AI. And specifically, it says here that while they continue to execute on innovations to reduce the cost of manufacturing and operations over time, they do expect hardware-related profits to be accompanied by an acceleration of AI, software, and fleet-based profits. Is this something we've been hearing along the way too, or does this represent a ramp up in the rhetoric on AI?
Well, I think it's just part of Tesla's story. And look, Q4 results are a tale of two cities. Tesla posted record $25.7 billion in Q4 revenue. It's going to be roughly $97 billion for the year, and they sold 1.8 million cars. That's whopping 55% of the U.S. auto market. That's not a bad year. But the big picture is growth has slowed from 51% year over year last year, 19% year over year this year. So the big story is BYD is coming on quickly. They will likely pass Tesla next year as the dominant EV seller in the world. So right now, Tesla is still number one, but they're going to have to find a higher gear to stay on top. The AI story is part of bringing costs down. The robo story is another part. And there's also Tesla's rapidly growing energy division. So these are all part of the picture that investors are going to have to keep an eye on. But get ready to see the big smackdown, Tesla versus BYD for global dominance in the EV sector.
Okay, and so Tasha, I guess the question for investors is, in 2024, what kind of a multiple does Tesla deserve? Because it's still very richly valued for right now. And I mean, the robo-taxi thing, I'm not buying it for any time soon. I'm not even sure that means people buy more Teslas if they can just rent them, and if that's actually good for the company overall. But how do you calculate what kind of valuation it deserves right now, given a lot of other companies are pulling back their revenue expectations and getting dinged?
So first, I'll say on robotaxis, I mean, I'd encourage everyone to look at the videos online that are coming out of FSD, full self-driving version 12. It's amazing. It drives like a human. People are doing full drives, zero interventions. So the fact of the matter is, robotaxis are already possible today, just in select areas. I'm not saying it works everywhere, right? But we have evidence that it's possible. We see other companies like Waymo also telling us that it's possible. But Tesla itself has great technology. And when we think of scale and the number of cars that they're producing, to put this in perspective, the data advantage that Tesla has is orders of magnitude higher than other players. Tesla is collecting or is able to look at data from more than 2 million miles per day of customers driving in full self-driving mode. That compares with other players like Waymo that, they might have collected single-digit millions in the lifetime of the project. So again, I think robotaxis are already here. Don't miss this opportunity. And again, I'm looking forward to hearing more about that rollout plan on the call.